I think 2023 could end up being one of the weakest years ever for the US dollar. I think a lot of people piled into the long dollar trade in 2022 based on Fed tightening and the idea that the Fed was going to continue to ratchet up rates to bring down inflation, and that got a lot of people into the dollar. I think what's going to get them out of the dollar in 2023 is the realization that the Fed is going to give up its inflation fight, not because it wins, but because it loses. And it's going to focus attention on the economy, which is going to be in an even deeper recession. And I think in 2023, the recession deniers are going to finally have to admit the truth. And there's going to be a lot of pressure on the Fed to stimulate the economy, especially when we see a big increase in unemployment, which we haven't had yet, but which is coming. But the only stimulus the Fed has in its tool chest is inflation. That's all it's ever had. The only thing the Federal Reserve does when it wants to stimulate the economy is create inflation. Except the problem is now that inflation is the problem. And you can't solve a problem by creating more of the same problem that you're trying to solve. The last couple of times the Fed was able to orchestrate the pivot, it did it when inflation was 2% or less than 2%. And that provided the cover for the Fed. Hey, it's okay to do this because we have really low inflation. In fact, it's too low. And so we can kill two birds with one stone. We can stimulate the economy and get closer to our 2% inflation goal, because we're going to stimulate the economy with inflationary monetary policy, which they claimed we needed. Of course, we needed it like a hole in the head because we don't need 2% inflation. Plus, it wasn't even 2%. That's only because they lied about it. They had a lie to get it to below 2%. It was actually probably 4%. And now, of course, it's double digit, although they won't acknowledge double digit because of the way the index is rigged. But my point is that let's say that we're back in recession, maybe even a financial crisis. You know, we're seeing it in a small scale play out right now in crypto and blockchain, right? You're seeing all the dominoes, one company after another going bankrupt, freezing accounts, because everybody owed everybody else money. And there was so much counterparty risk, and it's this, you know, and so everything is kind of imploding. But so far, it's kind of isolated, you know, to the crypto. Yeah, you know, you got Bed Bath & Beyond, they're filing bankruptcy. Of course, that was a meme stock. You know, you're mainly seeing this, you know, collapse in crypto, although there's still a long way to go down. What I think is going to happen is as higher interest rates work their way through the economy, you're going to see more problems in the credit markets blowing up, and it's going to be outside of crypto. Because remember, the mortgage crisis started with subprime. And when the Fed was out there saying, oh, don't worry, it's contained to subprime, I was saying, no, subprime is the tip of the iceberg. We're just seeing it in subprime first. It's the weakest link in the chain. But, you know, we're going to see it in the rest of the mortgage market. So we're seeing the credit problems first in crypto because that's the weakest link. But you're going to see, you know, broader problems throughout the economy because we've had 0% interest rates for more than a decade. You know, you can't build up that kind of drug addiction and then, you know, all of a sudden rates are 5% and, you know, there's not massive, you know, withdrawal. So let's say we have another financial crisis, we're in a deep recession, but inflation hasn't come anywhere near 2%. I mean, maybe it's not 8%, maybe it's 4 or 5%, right? That's still well north of the Fed's so-called target. So what happens if in an environment where inflation is already double or triple the Fed's target, but then the Fed gives up the inflation fight and says, no, we got to stimulate the economy, and they stimulate the economy by creating even more inflation. Well, now they're throwing gasoline on a fire. And so now a high inflation rate gets even higher. And in that environment, I don't see financial assets as a group doing well. So I think bonds get killed. You know, instead of going up with QE, they actually go down. Long-term interest rates go up, which is going to be a huge problem. High multiple companies that lose money, these prices continue to fall. The stocks that go up are, again, the real businesses. You know, the more they try to keep yields from rising, the more money they have to print to buy those bonds, which means the more inflation they create, which means the less attractive the bonds they're buying actually are. So the more bonds they buy, the more bonds they have to buy. And so they can't solve this problem. But if they really can succeed in keeping, let's say, long-term interest rates below 4%, which is where they are now, they're in the mid threes, right? If they do succeed in doing that, it's going to be because the Federal Reserve buys them all, But then whatever bonds the Fed is not buying are going to be, collapsing in price and soaring in yields. So they may be able to keep the Treasury yields below 4%, but they're not going to keep municipal bonds below 4%. They're not going to keep corporate bonds unless they start buying those things too, and mortgages and all that. But the more they buy, the more they have to buy because the more everybody else wants out. And if the Fed is there with a big bid in the market and the Fed says, we will overpay for your bonds, sell us all your crap and we'll overpay for it, well, everybody is going to hit that bid. But that just makes the inflation problem much, much worse. So, the Fed has put us into a box and there is no way out. And I've been warning about this for more than a decade. I knew exactly where we would end up. I just didn't know how long it would take to get there, or maybe the exact route we would take, but I knew where we would ultimately end up, and that is exactly where we are. But I don't think that the next bubble is going to be in the same assets as the past bubble. So when the Fed tries to reflate this economy, I don't think they're going to reflate the tech bubble. We had a tech bubble 20 years ago in the late 1990s, and then we had another one more recently. But I think that this next time, the money is not going to flow into that sector. And I think one of the main reasons is going to be inflation. I think that tech stocks were part of the low inflation story. Low inflation meant low interest rates, and that meant that companies that were growth oriented, that weren't expected to deliver profits until many years into the future, when interest rates and inflation were low, investors were willing to wait, and they were willing to pay up for the prospect of a big payday in the distant future. But now, if money is really losing value much faster than 2% a year, you don't want to wait 10, 20 years to get your money. Who knows what it's going to be worth by then? So I think investors are going to be looking for stocks that can show them the money right now. So it's not companies that are promising earnings in the future. It's companies that have earnings right now and can deliver those earnings to shareholders in dividends, and dividends that can go up with inflation. People are going to be looking for the stock market as an inflation hedge to get out of bonds, to get out of cash. And they want real companies. They want companies with pricing power. That's important in an inflationary environment. You have to be able to raise your prices without destroying your sales. Now, a lot of companies are not going to be in that position. When they raise their prices, their buyers are going to go away.